In this video, we're going to talk about Lucid Motors, trading under the ticker symbol LCID. We're going to cover the price action over the past few days, the company itself, and the recommendations regarding buying, holding, or selling the shares. If you would like to see more stock analysis videos, please like, comment, and subscribe to my channel. But before today's video begins, I'd just like to clarify a few things about the timing when my videos are recorded, uploaded, and how much they react to the latest market updates. Those are prepared, recorded on the day before, and scheduled for the next day. If there are significant and volatile movements during the trading day, they will not be reflected in the video itself. With that being said, to the extent possible, my analysis will be based on the medium term, or even the long term, and not necessarily on the intraday movements. The main reason why it shouldn't matter that much is because most people investing in stocks, or even just trading in and out of their positions, usually keep their positions open for at least a few weeks. With that being said, if there are significant movements in the stock price that happens afterwards, either they will not affect the overall picture, so in that case we will cover them the next time we're supposed to cover them, or if they are significant enough that they change the outlooks, then yes, I will do a follow-up video in the shortest delay possible with a reevaluation of what I think should happen next. Lucid Motors is a startup based in Newark, California. It manufactures electric vehicles and specifically targets the high-end segment of that market. The main appeal of Lucid is that it is based in the US and is widely considered as a potential rival and alternative to Tesla. This means that the market participants who want to either hedge their exposure in Tesla and those who believe in the sector of EV may consider investing in Lucid. Another appeal for the investors is that unlike EV startups like NIO, Lucid is based in and operates in the United States, so there will be little to no worry about the effects or consequences of remote or difficult oversights and geopolitical tensions. The recent catalysts have been focusing on the release of Lucid Air, a widely acclaimed vehicle from the critics, and may provide the company the capital to keep growing at a fast pace. The market cap of Lucid Motors is currently at $90.9 billion, and the enterprise value is at $7.46 billion. The market cap is the price tag financial market is willing to evaluate Lucid at, with consideration of its future potentials and the short-term fundamentals. The EV of the company is the net result of the company's assets once the debts are paid. Usually the market cap is higher than the EV, but sometimes it may not be the case due to the high leverage and potential short positions from the market participants. The quick ratio of Lucid Motors is 0.82. The current ratio is 0.82 as well, and the debt over equity is 0.003. The average trading volume of Lucid Motors has been 125.7 million shares over the past 10 days, and the daily volume has been 166.3 million shares, 131.6 million shares, and 198.4 million shares. The one-year beta of Lucid Motors is 2.16. Its 52-week high is $64.86, and its 52-week low is $9.70. Now, let's also talk about the options market for Lucid Motors. In terms of volume and open interest, the options market seems to favor the calls option side. Generally speaking, the put options mean that the market expects a pullback, and the calls mean that the market expects an upward trend. The key strike prices where there are the most interests are $50, $55, and $60. The story of Lucid Motors has been one where a lot of hope and despair have walked by, and where many have put their entire net worth on the stock back in late 2020 before getting completely stomped on. This current wave of new momentum is something that is really salutary for the shareholders who have been waiting for the better part of a year, frankly, hoping that the company would be able to overturn the negative context it was trapped in. Now that Lucid is finally in a new phase in its price action, I think that going forward, we should definitely be more careful with trusting the market when everyone seems to be overly optimistic, and to be also more patient with the same market when things seem overall desperate, because it's never completely black and white. Looking at the stock price going back to the 50s, before jumping back into stock, you should probably think about how it felt when the stock was trading below $10 and when the news sites were putting ever more doubt in our mind regarding whether the company can make a comeback. I think that the past few months have told us is that ultimately the market is a game of supply and demand. It doesn't mean that the company is doing something wrong, just that the shareholders, for one reason or another, have decided to sell their shares. The same reasoning applies the other way around as well. The stock price will eventually bottom out once those who decided to sell their holdings have done so, and mechanically the price will jump back up. I have bought and sold my Lucid share before the price reached that kind of level. But the unrealized losses did not affect my trading during that period of time, because my exposure in Lucid was limited to around 0.5% of my portfolio, and only once the peak was passed. So doing so may not provide you the kind of profits you were hoping for, or you may believe that the market will always present, but it makes sure that you stay in the game when things get rough. Having said that, I recommend to keep a foot in Lucid, but to make sure that you have between 1 to 3% of your portfolio as an allocated amount, not to buy the shares in one shot, so that eventually by gradually adding the shares, you can have a Lucid position at the best price possible. Your investment should also take into consideration the market conditions and the surrounding sentiment to determine what kind of asset should be picked, for how much and for how long. First of all, the financial market doesn't reflect the real economy. If the stock market is doing great, it doesn't necessarily mean that companies are hiring people, that salaries and living standards are rising. Sometimes it's the exact opposite that happens, because the stock market is a pool of money where things come in and come out, going to different sectors to be placed. The capital may be used to be invested in a company to improve its efficiency and productivity, but it can also be used to buy up shares and assets in order to make a profit. This phenomenon is called financialization, and it means that the more money is being used for non-productive purposes like merger and acquisitions, fees to financial sectors, buying back equity, and so on, the less there is for the real economy. Another way to put it is that ever since 2008, the Dow Jones has increased significantly. But people don't necessarily see this growth in tangible ways. This is why we gotta be careful with the assumptions that rising stock price means better outlook for the company. Sometimes it doesn't mean anything, other than the fact that the asset is getting more expensive to be bought and that their yields is going down as a result. Additionally, some new phenomenons are now palpable, such as the creation of new bubbles, the participation and influence of retail traders in specific situations, and the anticipation of a massive recession or at least pullback. Bubbles have always been created on and off over the past few centuries, but nowadays, it's quite interesting to see the speed at which an organic bubble can be created back in 2020. Because almost immediately after the major collapse of the financial market back in early 2020, the market decided to pour a massive amount of capital in the EV sector and anything that's related to it. Stock prices went up the sky, and for a moment, it really felt like any EV stock can be a golden goose. Another way to say this is that any SPAC with an EV company in it will become the next Tesla, right? Even if it didn't last that long, this episode definitely allowed the market participants to park a lot of their money in a sector, leaving it with either a lot of profits or at least avoiding incurring large losses because they left their money in the blue chips or the sectors heavily affected. The involvement of retail traders in companies has also been much more pronounced in recent months, especially in the scenarios of a short squeeze. Companies may have short sellers who believe that the stock will decrease in value, The short squeeze consists of buying the stock price up to force the short sellers to recover their positions, which will then also trigger an even bigger increase of stock price as a result. Of course, I'm not saying that this is always rational. I'm not even saying that those companies always have a convincing narrative. So, for example, if you play video games, ask yourself if you personally bought all your games at GameStop, knowing that you can buy the same games just online in the comfort of your home. But nevertheless, retail traders do have a much more significant influence in the stock price nowadays, for the better or worse. Personally, I think that as long as the volatility is high or gets higher, it'll create more opportunities. The final phenomenon is the anticipation of a recession. Many people have been expecting something of that sort to happen ever since 2008. There were quite a few companies that were supposed to go bankrupt because their debt structure is no longer sustainable or that their business model is bad. But overall, the system was able to hold its ground, especially in the North American market. This is partially because capital around the world often choose to come to the American capital market when things get heated back home. This is especially the case when geopolitical tensions increase around the world. In order to make sure that capital can provide a steady return without being affected too much by the central bank policies and inflations, I think that this phenomenon will increase its pace as time passes by, at least for the next couple of years. This is why we will likely see the blue chips continuing their ascension, even if for the growth stocks, things may be a lot more nuanced. The bottom line in all this is that the environment is getting more uncertain and volatile in a context where asset yields will probably remain quite low, because the real economy cannot be improved with just money. As far as we're concerned, this means that the patience would be a great virtue for all of us, and that there will be plenty of opportunities to eye for better prices. With that being said, always make sure to keep your positions diversified and keep the risk level under check. Speculative positions should play a small part in your overall portfolio. I would say it's better to keep them below 10 to 20% of your total holdings. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.